This session I'm going to cover how you can trade different sessions using liquidities. So now, for example, we have this is Asia session. So this was the highest point of Asia session, and this was the lowest point of Asia session. So price, that's what price did during Asia session. And then it did that. Then we come out. Maybe we did that. And then London session opens, and so two things are likely to happen here. Either price is likely to come down, sweep Asia low, and then we reverse, we continue, we start going up, or price is likely to just, so either price will do this, come, sweep Asia low, then we start going up, change momentum, we start going up. So that's scenario A. Or price is likely to do this, run through Asia low and continue going down. So those are the two likely scenarios that price is likely to do whenever you're looking at sessions and the liquidities. And in this case, session liquidities are the session highs and the session lows. The highest point of Asia high of Asia session and the lowest point of Asia session. So now, whenever we are looking at the markets, I want to make something very clear. Anytime you're looking at the markets, there are some things that we look at for entry, which is like our entry model. And for us, our entry model, this is what our entry model looks like. Our entry model is more of like a reversal pattern, trying to identify a reversal. Let's say price was going down. Because price is going down, it's making lower low, lower high, lower lows, lower high. And then suddenly price does this. We come close above this low high with a displacement candle. So when that happens, that for us is a confirmation that a reversal is happening, that price is not willing to continue going down anymore. Instead, it's now willing to go up the opposite direction. And that is what we call a reversal. So we can, having that in mind, that is what we use for entry models. So you can be in the market, you're looking at the market, you're not sure if price is likely to go up or down at this point. You're not sure where London price will do during London. Then you see price doing this. Now this is what price will do, right? We come. So at this point, price has taken out Asia low. So if you look at Asia low liquidity, that's what has happened. So you anticipate two things are likely to happen at this point. Either price will retrace and then make a lower low, or price will reverse. So what are you going to use as your confirmation for reversal? The only thing you're going to use as confirmation for reversal is when price comes and closes above this swing high. Because remember, this is a low high. A low high is supposed to be intact. Market structure. This is market structure 101. If you're bearish, you should be making lower low, lower high, lower lows, lower high. So now when price comes and breaks our lower high with a displacement candle means a big candle and we come and close above this swing high. Once price does that, that for you is a confirmation that at this point, price now wants to reverse to go to the opposite direction. And when price does this, you'll need to look for any PD array on this leg. It can be a fair value gap, it can be an order block. And here, all this you'll be doing it on the lower time frame. So lower time frames, 15 minutes and 5 minutes. Between 15 minutes and 5 minutes, those are your lower time frames that you can use to check market structure shift and confirm. So now any PD array you look, you enter and then you ride that move and use any of these as your take profit. Any of these buy side liquidities that we have here as your take profit. So that is how you can ride or trade a liquidity sweep of a session. But remember, liquidities of sessions, we call them time-based liquidities because this is the highest point or the lowest point of a session. Highest point of a day, previous day high or lows, that one is also time-based liquidity sweep. previous week, the highest point of a week and the lowest point of a week. That one is also called time-based liquidities. So those liquidities are very important and they can be used to trade on its own as a strategy without really needing even to know directional bias. If the market is biased to go up or down, you just use it. Either we'll sweep or we run. If we sweep, you know we are reversing, you know what to look for. If you're running, you will just see it will run. So if you are running liquidity, let's say price, now like, okay, this is a good example here. So price starts going up. Here we also have another liquidity. We have the highest point of Asia, buy side liquidity. So we know very well two things are likely to happen. Either we'll sweep and reverse or we run through and continue going up. So for you to confirm that price is running through a liquidity and willing to continue going up, so this is what you'll see. You'll even find price will close above it with a candle. It will close above it with a candle, even 15 minutes candle or 5 minutes candle, or even if it does not, it might retrace but still go above it, then retrace and continue going up. So if this happens, you know that this is a liquidity run has happened and price is willing to continue going up, and that's how you can take advantage of this move of price going up, going to the opposite direction. So we can go and have a look at the charts and look at some examples. This is a good example here. So during Asia, price came, we took this liquidity, price made a lower low, did that, and then finally we reversed. Here we go. And then price reversed. So when this swing high is what you would have used as your market structure shift, this swing high here. So once price closes above this swing high with the displacement candle, that shows you that price is willing to go up. And then here, what do we do? Price comes, takes this Asia high. We take this Asia high, then price drops down. There's also another example. Asia before London open, price comes, takes out Asia low. So if price is supposed to continue going up, going down during London session, you anticipate this swing low, price will close, displace it and close below it. But instead, what does price do? Price reverses. And for you, you confirm your reversal when a swing high. This is our swing high here. Price closes above the swing high. Remember the swing high, we are calling this a swing high because price made a lower low. It traced and then made a lower low. So that last leg, the last leg before price makes the major lower low, that is what we use for swings. If you're going down, so this high here before price made the lower low, that is what you're going to use to mark your swing high. And for yeah, swing high, and then for the other direction also it's the opposite. So you get your market structure shift here, you use any PD array for entry and you take advantage of that move.